Would you like to know about a rare deal in this expensive stock market? Want a market-beating yield and double-digit dividend growth? Like the idea of being invested in a business with almost no competition? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major U.S. defense contractor. Major defense contractors benefit from a powerful 1-2 punch. The first punch is the necessity of their products. The second punch is limited competition. This combination has proven to be very fertile ground for growing revenue, growing profit, and growing dividends. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Huntington Ingalls Industries Inc., which appear to be trading at a significant discount today. Huntington Ingalls Industries Inc., stock ticker HII, is a major American defense company operating as the largest independent military shipbuilder. Founded in 1886, Huntington Ingalls is now an $8 billion by market cap military giant that employs over 14,000 people. Huntington Ingalls primarily designs, constructs, maintains, and repairs a range of nuclear and non-nuclear ships. These ships include aircraft carriers, submarines, and amphibious assault ships. The United States Navy is their largest customer, generating almost 90% of the company's revenue. The company operates across three segments: Newport News, 60% of fiscal year 2020 revenue, Ingalls, 29%, and Technical Solutions, 14%. A business like this can make for an excellent long-term investment, primarily because of the necessity of the products and the scarcity of competition. This speaks to why this stock has amazingly compounded at an annual rate of 21% over the last decade. It's very simple. The US isn't suddenly going to stop needing to protect itself via sovereign defense. If anything, sovereign defense only becomes more critical over time. And Huntington Ingalls is often competing against, well, nobody. For instance, Huntington Ingalls is the only builder of nuclear-powered aircraft carriers for the United States. If the US military orders a nuclear-powered aircraft carrier, Huntington Ingalls is the company that will build it. This is a powerful 1-2 punch that bodes well for Huntington's ability to increase its profit and dividend over the long run. The company has already increased its dividend for 9 consecutive years. Their 5-year dividend growth rate is 18.6%. That astounding dividend growth comes along with the stock's current market-beating yield of 2.3%. This yield, by the way, doesn't just beat the market, it's also 80 basis points higher than the stock's own 5-year average yield. And with a low payout ratio of 27.5%, this is a very safe dividend. Looking at business growth, Huntington Ingalls increased its revenue from $6.575 billion in fiscal year 2011 to $9.361 billion in fiscal year 2020. That's a compound annual growth rate of 4%. This is a good result. I usually look for mid-single-digit top-line growth from a mature business like this, and they delivered. Meantime, earnings per share grew from $2.91 in fiscal year 2012 to $17.14 in fiscal year 2020, which is a compound annual growth rate of 24.81%. Incredible bottom-line growth, which shows us where the dividend growth came from. It's important to note here that I'd moved the starting year for the earnings per share growth rate 1 year forward. That's because the company registered a GAAP loss for fiscal year 2011. A combination of buybacks and margin expansion drove a lot of the excess bottom line growth. The outstanding share count is down by about 15% over the last decade, while net margin has doubled compared to a decade ago. Looking forward, CFRA projects that Huntington Ingalls will compound its earnings per share at an annual rate of 9% over the next 3 years. This kind of earnings per share growth, while certainly strong, would represent a material drop from the kind of growth the company has enjoyed over the last 9 years. In my view, that really underestimates what this company is capable of, but Huntington Ingalls is kind of used to being underestimated. For example, the company recently reported first quarter GAAP earnings per share of $3.68. That beat consensus expectations by a whopping $1.07. And let's keep in mind, that their backlog just reached a record $48.8 billion, almost 6 times the company's entire market cap. That said, the timing of contracts and deliveries can impact growth over a short period of time. However, even if Huntington Ingalls only produces a compound annual growth rate of 9% for its earnings per share over the next 3 years, that would still be more than enough to power low double-digit dividend growth for years to come. Their low payout ratio gives them that flexibility. With the good possibility that they actually do better than CFRA's expectation, and considering the 2.3% yield, there is a spectacular combination of current income and dividend growth at work here. Moving over to the balance sheet, the company maintains a rock-solid financial position. The long-term debt-to-equity ratio is 0.89, while the interest coverage ratio is over 8. Profitability is robust. As pointed out earlier, the expansion in net margin in recent years has been nothing short of extraordinary. Over the last 5 years, the firm has averaged annual net margin of 7.44% and annual return on equity of 36.14%. For perspective on that net margin expansion, net margin for fiscal year 2012 was below 2.5%. No matter how you slice it, this is a high-quality business, and they do benefit from durable competitive advantages, including massive barriers to entry, scale, technological know-how, R&D, IP, long-term contracts, high switching costs, and a unique government relationship. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. While competition is limited or sometimes completely non-existent, regulation is amplified by way of direct regulatory oversight. The very business model introduces geopolitical risk. The current democratic regime in the US government could aim to limit defense spending, which would impact the business. Customer concentration is a risk. There's also execution risk, especially with such a large backlog. The company must continue to complete projects in a timely and cost-effective manner in order to avoid backlash, scrutiny, and a possible reduction in order flow. These risks are very acceptable in my opinion. That's especially true if the stock is bought at an attractive valuation. With the stock still well below its pre-pandemic pricing, I see the valuation as very attractive. The price-to-earnings ratio is 12.2. That's substantially lower than the broader market's earnings multiple. It's also well below the stock's own 5-year average price-to-earnings ratio of 15.6. We can also look at cash flow. The stock's price-to-cash flow ratio of 7.7 is way off of its own 5-year average of 10.7, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. This dividend growth rate is at the high end of what I ordinarily allow for, but I believe this company deserves it. The long-term earnings per share growth rate and long-term dividend growth rate are both more than double this number, and CFRA's near-term earnings per share growth forecast, which is arguably conservative, is also higher than this. In addition, the payout ratio is very low. I think Huntington Ingalls could exceed this expectation over the next few years, but I'd rather err on the side of caution when modeling something out over many years. The dividend discount model analysis gives me a fair value of $246.24. The reason I use a dividend discount model analysis is because the business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates HII as a 3-star stock with a fair value estimate of $201. CFRA rates HII as a 4-star buy with a 12-month target price of $249. I came in pretty close to where CFRA is at on this one. Averaging the 3 numbers out gives us a final valuation of $232.08, which would indicate the stock is possibly 15% undervalued. Here's the bottom line, guys. Huntington Ingalls Industries Inc. is a high-quality defense firm that powerfully benefits from providing necessary products with limited competition. With a market-beating yield, an extremely low payout ratio, double-digit dividend growth, and the potential that shares are 15% undervalued, this is a compelling long-term investment opportunity for dividend growth investors. And now for a special news announcement. Apple Inc., stock ticker AAPL, just hit another all-time high after JP Morgan analyst Samik Chatterjee raised his target price to $175 a share. I've been covering Apple for a long time, and for years and years now, I've been hearing from other investors about how expensive this stock is. Well, those investors have been dead wrong, and they've missed out on a lot of money. If Apple isn't already in your portfolio, you might want to consider changing that. As I've said before, this is a must-own stock for serious dividend growth investors. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did. and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.